Welcome, everybody. I'm Sharon Tennyson from Cornell University. This is the ARIA session on topics in risk and insurance at the AEA meetings in 2021. We have 4 papers to present to you today. Each paper will be presented for about 20 minutes with a discussion following of about 5 minutes. And so that will leave us approximately 5 minutes for questions after each paper. We're in the webinar format, and so questions will have to be entered through the chat. Please feel free to enter any questions in the chat at any time about a paper that's being presented, and then I will try to facilitate questions after the presentation and the discussion. Okay, so why don't we go ahead and begin? Our first paper will be presented by Alex Jia and Zenan Wu. It's Adverse Impacts of Regulatory Reforms and Policy Remedies. Please go ahead and share your screen.
Thank you very much, Sharon, for introducing us to this presentation. So this is a joint work with Alex, and I will present the first part of the paper, and Alex will present the second part of the paper. So the title of the paper is Adverse Impact of Regulatory Reforms and Policy Remedies, Theory and Evidence. So we have a simple theoretical model of the paper, and we will present some evidence that support the theory. So that's why we have 2 presenters. So this is essentially what we do in the paper. We first investigate both theoretically and empirically the impact of a regulatory pressure shock on the risk-taking behavior of financial institutions. And we try to discuss some potential policy remedies. So let's delve directly into the theoretical model. So we have a very stylized, simple 2-period portfolio choice model. In the first, and the firm is endowed with some capital and a liability 1 minus psi, and we normalize the size of the firm to unity. So the capital adequacy level actually is exogenous and create the heterogeneity across all the firms. And firm's investment is solely funded through its capital and liability. So in the first period, the firm simply choose a portfolio composition of R units of risk assets, and he invests the rest of the money to the safe assets. In the second period, the return of the asset will be realized, and the firm may incur a regulatory cost, which we assume as a constant C. In the model. We do some generalizations, and the result actually is robust. The safe portfolio will generate a deterministic gross return X, which is assumed to be greater than 1 per unit. And the risky portfolio may generate a gross return which can be high or low. So in the case of the high return, we assume the return is Y, and in the case of low return, we simply normalize the return to 0. And we use the parameter S to indicate the outcome of the risky assets. So to be more specific, if we assume S equals to 1, it refers to the situation in which the gross return is Y. And if we use S equals to 0, then it simply says that the investment just fails. And again, without loss of generality, we assume that each state occur with equal probabilities. So the first assumption we impose into the model is that we assume that a risky portfolio will generate a strictly higher expected payoff than a safe portfolio. So this is very standard assumption. If this is violated, then there is no trade-off for the firm. And now we come to the second period. So fixing a firm's strategy R, which is the amount of investment on the risky assets, and the realized outcome of the assets S, we can simply derive the firm's ex-post profit as follows, as a function of S and R. And then we can update the firm's balance sheet according to the following table. So the capital will increase from psi to psi plus the net profit, and the liability remains the same. The assets will be updated accordingly. And next, we introduce the key components of the model. So we want to model capital regulation in a general way. So we assume that the firm will be subject to a capital regulation, and the firm's capital adequacy is measured by a ratio between firm's capital level K and some function, some amount F. And the F can be interpreted as the minimum capital requirement based on its asset level A, its liability L, and its investment strategy R. So the ratio F over the ratio K over F can be interpreted as the capital adequacy level ratio in the banking sector or the solvency ratio in the insurance sector. So a regulation will be triggered, the intervention will be triggered if the firm's ratio K over F falls below some predetermining threshold tau. So in such a scenario, the firm has to pay a cost, a regulatory cost C. So now we will see that a capital regulation is fully characterized by a function F and the threshold tau. And F actually is the formula the regulator uses to determine the firm's capital adequacy ratio. Next, we impose more structures into the into the F function. So we assume that the F function actually is increasing in the asset level, in its liability level, and it is increasing in the amount of risk that the firm take. And also we impose some homogeneity of degree 1 into the F function. So a simple implication is that we actually assume that the regulation is size neutral. So suppose we have a firm and we double its size. And then the new firm actually use the same strategy, then we will obtain the same amount of capital adequacy level. So this is essentially what the last condition say in our model. And given all the analysis, we can take another look of this ratio. So we will know that this ratio actually can be simplified to the second equation, K over L. On the left-hand side, we have K over L, which is the capital liability ratio. And on the right-hand side, actually, we have a new function eta, which can be produced from the F function and the tau, the threshold tau. So actually, the right-hand side, eta of R actually specifies the minimum capital liability ratio that is required to avoid regulatory intervention. So now we will see that working on the F and the tau actually is no different from working on eta. So from now on, we can work on the eta function. We can use the eta to capture a capital regulation. And for the sake of simplicity, we impose more structures onto the eta function. We assume that the eta function is convex. So it simply says that the capital regulation will restrain risk-taking in some sense, and it makes our life easier because we can have a well-behaved expected profit function for the firm. And given all this preliminaries analysis, we can formally write down the firm's maximization problem. It's very simple. So the firm try to maximize expected payoff net its expected regulatory cost. Given all this, actually, we can fully characterize the firm's optimal portfolio structure. And you will see that we have two cases from this proposition, and the proposition will be visualized in the following two figures. So on the horizontal x-axis, we have the firm's exogenous capital level in the first period. On the vertical x-axis, actually, we have the risk-taking behavior, firm's risk-taking behavior. And for the first scenario, we will see that in such a scenario, when this condition is satisfied, which means that the eta function actually is, at some point delta is relatively small, which means the regulation is less stringent, then we have a monotonic relationship between psi and the capital level, initial capital level, and its firm's risk taking. And in the other situation, we will see that first, the unhealthy firm, they will reach the maximum amount of risk taking, and then we have a sudden drop, and then it go back again. So we interpret this as a U-shape, a non-monotonic relationship between firm's capital level and the risk taking. So now let me briefly introduce the intuition for this result. So the intuition is very simple and is as follows. So when the regulation is loose, no firm actually will incur a regulatory cost in a good state, which means when the outcome of the risky assets turn out to be good, no firm has to worry about this part. So every firm actually will only be concerned about the regulatory intervention in the bad state. If that's the case, when the firm makes the investment decision in the first period, actually we know that firm that is healthier are able to bear a higher amount of risk. So they will take the risk to just to meet the standard. So we will see that a healthier firm actually is able to bear more risk, and that's why we obtain the monotonic relationship. However, when the regulation becomes more stringent, the situation actually, the analysis for the healthy firm will be exactly the same as what we see previously. However, for a firm with a low capital adequacy level, actually he will suffer a regulatory cost in the bad state when the outcome is zero, regardless of its investment. If that is the case, the firm will turn turn to concern from the bad state, good state, the bad state to the good state. If he only concerns about the good state, we will see that in such a scenario, increasing the risk in the good state not only will generate a higher amount of expected payoff to the firm, return to the firm, it also weakly reduces the firm's probability of facing a regularity intervention. When he makes the decision, he only concerns the good state. So he will try to maximize his amount of risk, the amount of risk portfolios. So that's the intuition. So in such a scenario, all the firm will take the maximum risk. Given all this, then we try to consider a reform, a regulatory reform in the model. So as we have previously mentioned, we use the eta function to capture a regulation. So we simply try to compare a regulation's original regulation eta and the reform eta tilde. So we say that a firm is subject to a higher amount of regulatory pressure under the after the reform eta if eta tilde actually for any amount of risk-taking level is greater than the original original level before the reform. So this is essentially the definition of the regulatory reform. Given this reform, we can conduct some comparative statics of the model. So we have the second proposition. So it illustrates the comparative statics. So again, it can be visualized in two simple figures. So this is the first graph. So the black curve, the black solid curve measures what we have before the reform, and the red dotted curve measures what we have after the reform. And when the standard for the regulation increase over time, we will see that in such a scenario, previously all the firms, because the regulation is loose at the very beginning, all the firms, they concern the bad state. After the reform, all the firms again concern the bad state. So, but we know that the standard becomes higher and higher. So each firm is able to, the amount of risk that the firm is able to bear actually will be less than before. So now we will see that all firms will try to uniformly decrease the amount of risk after in such a scenario. However, when the reform becomes much more stringent than the previous one, we will receive what we observed previously, a U-shaped relationship. And if we put two figures into one, we will see that the unhealthy firm, they previously start concerns the bad state, but now when they make a investment decision, they only concerned about the good state. So they will try to increase their risk from a very low level to a very high level, because they now become much more desperate than previously than before. However, for the healthier firm, previously they concerned the bad state. Now again they concern the bad state, and because the standard increases, so every firm will try to reduce the amount of risk. So from this result, we will see that there might exist some non-monotonicity impact of this reform. And this is the unintended consequences we want to capture in our subsequent empirical analysis.
Thanks, Donna. I will take over from here. Next slide, please. I will jump into the empirical results. First, I would like to discuss the sample already. Yes, we use the Chinese risk-oriented solvency reform as a regulatory shock to test the predictions in our theory. The uniqueness of this reform basically can be considered a reform from Chinese Solvency I to Chinese Solvency II. The similar reforms happened in United States in early 1990s and in Europe in early 2000, I think. And the uniqueness of this reform is that in the middle of the reform, in the last year of the reform in 2015, each insurer was required to report solvency ratio in both systems, in old and the new, so that the difference between these two systems can be used as a measure of the capital shock. As we see, we use the difference between the two ratios as the capital shock. If this shock is positive, then it means that the regulation become more loose for a firm, and it's negative. It's more strict for a firm, and we measure a similar way of the risk-taking activities of a firm. We use the following two measures to capture the asset risk, the opportunity asset risk, and the volatility of asset to liability ratio to capture the asset risk of each and every firm in each year. And then we also try to identify empirically the threshold, the turning point that this regulatory shock might change its impact direction. We use two alternative ways. One is the regulatory attention threshold, which means once a firm is below 150% of the solvency ratio, the regulator will invite some regulatory talk or will have some special attention on a particular firm. And we also use threshold regression to find some estimated thresholds. So I would we use both life and non-life insurers in China. That's the complete market. I will jump over the summary statistics to the results. Yes, this results basically saying that there exists a positive relationship between solvency ratio or capital ratio and the risk-taking activities of insurance company. This is a replication of existing literature and also confirm our hypothesis one as Zonan shows in the draft, in those charts. And next, this is our core results about hypothesis two. These four negative coefficients basically suggest that for those unhealthy firms with low solvency ratios, once the capital regulation becomes stricter for them, they would actually increasing their risk taking. But once the regulatory become more relaxed for them, they will reduce their risk taking. This is against the regulatory intention. And those positive coefficients below indicates that for those healthy firms with a good initial solvency ratio, their behavior is follow the regulatory intention. Next. And and we also do this for life insurers. We get the same conclusions, and we use both the regression estimated thresholds and also the regulatory intention threshold. Both thresholds suggest that firms with low solvency ratio actually against the regulatory intention. They increase their asset risk taking once the regulatory pressure become heavier for them. And this results shows that the results is actually driven by this negative capital shocks, which means the yes, I think I will wrap up in 1 minute.
Yeah,
so
sorry, I don't know how to make it stop.
Okay, no problem. The main results. So previous page, please. We also have some. This is a result showing the before and after the reform analysis. The reform is implemented in 2016. So our results is actually only appear in the post-reform period, not in the pre-reform period. So this is the result. So I will discuss some policy remedies. We basically have 3 policy remedies. One is that we can increase the regulatory penalty. So that absolutely helps that those healthy firm will try to behave. And the next is we can increase the risk sensitivity of the regulation. So we impose higher risk factor for those more risky assets. Basically, that's the intention. That also reduce the aggressive behavior of unhealthy firms. And the last policy remedy we suggest is we improve the second pillar, which is the ASSA in the US and the European context. We call it SAMARA in China. So if we impose a stricter or more relevant second pillar, that also help to improve the performance of unhealthy firms. I think that's the end of my presentation. Thank you.
Great, thank you very much. Greg Niehaus is our discussant for this paper.
Does that work?
Yes, thanks,
Yes.
Greg.
Okay, sorry it took me so long. So I appreciate the opportunity to discuss the paper. Since there's little time, I'm just going to jump into my concluding comments. I think this is an interesting paper and it's on an important issue. And I learned a lot about capital regulation in general, but a lot about Chinese regulation in particular. Also learned about the theoretical and empirical relationship between capital regulation and risk taking. I emphasize empirical here because I think the model is a nice model and formalizes the intuition that sometimes firms might gamble and go for broke if they're in a really bad capitalized situation. But I think the main contribution is with the empirical analysis. And the main message is that China went from what I'm going to call a volume-based capital regulation system to a risk-based capital system in 2016. And that imposed tighter capital regulation on firms in general. I mean, some were, for some it got weaker, but for the majority it got tighter. And that induced some firms, especially those with very low, that were very poorly capitalized, to take more risk. And I think that's an interesting result. And then they discuss policy remedies for dealing with that situation. So I'm going to make some suggestions for improving the paper. One theme in these suggestions would be to, both in the model and in the empirics, would be to make capital endogenous as opposed to exogenous. But let me just jump to the empirical analysis. The main model that they estimate, I'm simplifying and changing some terms so that I make it easier to follow for me, which is they look at the change in asset risk from 1 year to the next. That's the dependent variable. And the main variable they're using to explain it is this capital shock variable. And that capital shock variable is the difference between the solvency ratio under the risk-based capital, the new system, and the old system. And that capital shock variable is interacted with the threshold variable, which essentially identifies well-capitalized insurers. And so the impact of capital shock on the well-capitalized insurers will differ from the poorly capitalized insurers by the beta 4 coefficient. And then it's also interacted, but the results aren't shown in the table, with the pre-shock period. And all of this is motivated by the theoretical model. The comparative static of the theoretical model implies this type of specification. So this capital shock variable is highlighted as one of the main contributions of the paper because it's motivated as an unexpected exogenous shock. And I think a little more discussion about this would be worthwhile, in part because this change in capital regulation was discussed several years prior to 2016. And my guess is some insurers would have, in anticipation of the change, changed their capitalization and their risk prior to the time period that the regulation changed. My intuition is that only works against finding the result that they have. And so I think it's worth discussing. This capital shock variable is also motivated as a unique opportunity to evaluate an insurer's capital adequacy under two different systems at a given point in time. And I don't know whether that's really true, because if we know the formulas for the different capital regulation and given adequate disclosures, that I admit that's a big assumption, I should be able to calculate the difference under different systems in any given point in time, not just in 2015. So I think that should be addressed. The results indicate that as the capital shock variable decreases, which means that there's a greater reduction in the solvency ratio under the risk-based capital system relative to the volume-based system. Risk increases, that's asset risk increases for the poorly capitalized insurers. But if you add the coefficients together, there's really no effect on the well-capitalized insurers. One thing that I think is missing in the paper is a discussion of the economic magnitudes. I don't know if I did it correctly, but they appear to be quite large, and perhaps even too large. But I think that should be discussed. Other suggestions would be to look at the responses to other variables. This goes back to my initial comment about making capital endogenous. I think you would expect insurers to not only adjust their risk, but also their capital, maybe reduce dividends in some cases. The paper is all about regulatory capital, and I think that's important, but I think some discussion of economic capital and how that plays into the decision-making of insurers should also be discussed. And this might be another paper, but if the risk-based capital system is anything like the US system, there's different categories, and looking to see how insurers shift assets into higher risk securities within categories, I think would be an interesting analysis. Again, I think it's an interesting paper on an important topic, and I think if you read it, you'll learn a lot. Thank you.
Great, thank you, Greg, and thank you to the authors for an interesting presentation. We don't have questions in the chat, and we're also running slightly behind schedule already. So I will invite the authors to reach out to Greg to discuss his comments or respond to his comments if you have such responses, or if we have time at the end of the session, we can return to this. But right now I'd like to move on to our second paper, which will be presented by Christian Kubica on fundamentals-based insurance runs.
Can you hear me? Does it work?
Yes,
yeah,
terrific.
Perfect. Thanks a lot. Title actually changed slightly during the last year to Life Insurance Convexity. Thanks so much, Sharon, for including us in a session. Thanks everyone for coming. This is joint work with Nico Broholla and Helmut Grindel, who are both at Goethe University Frankfurt and the ICIR. In this paper, we look at life insurance companies. Why are life insurers interesting? Well, first of all, they're super important participants on financial markets. We know from previous work, such as from Pab, who's going to be our discussant, and his work with Andrew Lull, that their investment behavior can have a significant price impact. And so it is important for us to understand what drives their investment behavior. Second, life insurers are very important for households who invest roughly 40% of their net worth in life insurance products. And the majority of those products are long-term savings policies. These savings policies are used by the households typically to save for retirement so they can have a long time until they mature. And in most jurisdictions in the world, they have two key features. The first key feature is a guaranteed minimum payout at maturity. It means if you invest €1 to your life insurer, the life insurer promises you to pay back X euros at maturity. However, you don't have to wait necessarily until maturity to get paid out. The second key feature of most policies is an early withdrawal option, a so-called surrender option in the life insurance context. This option allows you to withdraw your savings early before the maturity of the contract. And so there has been a lot of focus recently, particularly on the guarantees in those policies and how they relate to financial stability and fragility. In this paper, we focus on the second feature here, the surrender option. And in particular, we argue that these surrender options in policies result in significant liquidity risk, in the sense that when there's a lot of policyholders that surrender their policies, this can force life insurers to sell assets, which can have adverse price impacts on financial markets. To motivate why we think this is important, let me tell you some key stats about surrender payments in Europe. The annual surrender payments of life insurers in Europe exceed 300 billion euros in total in the past years. To see whether that's significant relative to the insurer's cash flows, here in those box plots, you can see the distribution of surrender payments to policyholders that surrender their policies relative to the insurer's premiums in the red boxes and the total payout to policyholders in the blue boxes. And what we see is that for the median European countries, actually for most European countries, these surrender payments are roughly 40% of both the premiums, their main source of cash inflow, as well as the total cash outflows. So indeed, surrender payments are economically pretty large. The question is, what shock can trigger an increase in those surrender payments? And in this paper, we focus and argue on interest rate shocks. We show empirically that when the market interest rate, particularly the German government bond rate, when that increases, that incentivizes more policyholders to surrender their policies early. And so what happens is that for an average life insurance policy, less policyholders wait until maturity and more policyholders surrender early. So the average duration decreases. This is something which is known as convexity in the fixed income literature and motivates our title. So that's the empirical analysis. We then ask, why do we care? Why do we care about the link between interest rates and surrender activity? We provide one answer to this question, which is we care because if there is a lot of surrender activity, this can force insurers to sell assets in order to being able to pay out those policyholders that surrender their policy. And then we set up a very granular calibrated model to estimate these asset sales and the price impact, which under plausible conditions is roughly 1%. We contribute to a growing literature on the financial fragility of insurers. Historically, the literature has focused on non-insurance business, but more recently, the literature has highlighted also that fragility can come from the insurance business, and this is exactly where our paper comes in by showing that the core features of those life insurance policies, life insurers, right, can lead to substantial liquidity risk, which interacts with changes in the interest rates. And this is because of the surrender options. There has been a literature on the correlation between interest rates and surrender activity, which is called the surrender rate hypothesis. Often more recently in a paper by Till Firsterman, he shows that it is optimal for policyholders to collectively surrender their policies when the insurer is basically bankrupt. So we add to these two literatures by providing a causal identification of the effect of interest rates on surrender activity and a calibrated model with cash flows. So let me talk about the main trade-off in the paper. The main trade-off comes from the decision of a policyholder whether to surrender her life insurance policy or not. So here's a stylized version of this trade-off. If the policyholder holds on to the policy, then the benefit of staying with the insurer is basically the future policy returns she receives from the insurer, discounted at the current interest rate. Instead, if the policyholder surrenders, she receives the current cash value. So that is the value of the current savings, including the past policy returns the insurer has granted to the policyholder. And now the key question that we ask is, how does that trade-off change when there is a change in the interest rate? And there are two key observations that we make when looking at life insurance policies. The first observation is that the cash value which you receive when you surrender your policy, that this is largely independent from the interest rate, at least in the short and medium run, and this is because life insurers guarantee this cash value. Secondly, because insurers invest their assets in long-term investments, the policy return here in the nominator is largely insulated from changes in the interest rate. And so what happens is when the interest rate increases, the benefit of staying with the insurer goes down. The intuition is that the market value of the assets of the insurer decreases, so there is a smaller benefit of staying with the insurer. Instead, as a policyholder, you want to switch to the cash value, which is independent from the interest rate, and so there is more incentive to surrender. This is our main hypothesis. We test this with novel data that we collect from the German federal supervisor, the BaFin, which has a history of roughly 25 years. And in this data, we have the surrender rate, so the percentage of life insurance surrendered annually at the insurer level. And this is our main dependent variable. The main independent variable is the interest rate. So we want to change how the surrender rate changes when the interest rate changes. So here we use the 10-year German government bond rate. So here's our baseline results. A simple OLS regression shows there's a statistically significant correlation between the current interest rate and the current surrender rate, controlling for heterogeneity that is time invariant across insurers, as well as controlling for macroeconomic environment. And this effect remains statistically highly significant when we lag the interest rate by 1 year, when we include additional control variables. The effect is also highly economically significant. What we worry about is that there is reverse causality, namely that when there is a lot of surrender, this incentivizes insurers to sell more assets, which affects prices, which increases the interest rate. Unfortunately, we cannot include year-fixed effects, which would absorb aggregate net sales and purchases by German life insurers. And so instead, in the fourth column, I provide you some evidence on the mechanism we instead have in mind. And this mechanism is that policyholders surrender because of their interest rate sensitivity. In the fourth column, what we show is that when guaranteed returns for life insurance policies are higher, then this leads to less interest rate sensitivity in the surrender activity. And this is totally consistent with the idea that policyholders are yield oriented. So they react less sensitively, less severely to a change in the interest rate when the insurer promises a high guarantee. This guaranteed return here is only for new policies, and so we hypothesize the effect should be even larger when an insurer writes more new business. And this is exactly what we show in the fifth column, where we interact the coefficient with the insurer's share of new business. And now what's nice in the specification is we can control, we can include year-fixed effects because now the interaction term is at the insurer level. So that provides a lot of convincing evidence, we think, on the mechanism. Now we additionally push causality by using an instrument. And here the idea is that when the US Fed changes its monetary policy, then this affects US government bond rates, and by an arbitrage channel also German government bond rates. However, because German life insurers don't hold many US treasuries, actually less than 1% of US treasuries outstanding, it is very unlikely that the behavior of German life insurers affects in any way the US monetary policy. And so we proxy the US monetary policy by the federal funds rate and use it then as an instrument. Here's the first stage below, which shows that indeed the federal funds rate is highly relevant for the German government bond rate. And then we re-estimate our models using this instrument, and which provides very robust evidence and confirms our baseline results. So this first part of the paper is about showing that there is a link from interest rates on surrender activity. Now, the second part is about why do we care? Why do we care? We care if life insurers are forced to sell assets on the financial market and thereby have adverse price effects. To estimate those price impact, we set up a very granular model, of which in the center is a representative German life insurer, which we calibrate to the average German life insurer in 2015. This life insurer sells policies that have those key features I described to you. And importantly, in 2015, this insurer starts in our model, including all the legacy business, all the policies that life insurers sold in the previous years. So we go back to the 70s because those policies have very long durations. And then the key mechanism that we are interested in this model, the key effect, is to see whether an increase in the payouts to policyholders that surrender their policies can force this insurer to sell assets on the financial market. So the heart of the model is the decision of policyholders whether to surrender their life insurance policy or not. And this is endogenous in the model, and it goes back to the trade-off I showed to you before. Basically, the decision of a policyholder in a model is determined by the benefit of staying with the insurer, the discounted future policy rate, and the cash value. Now we add another component here, which we call the net costs. And this can be transaction costs. It can be negatively related to the liquidity need of policyholders. And we allow it to vary across policyholders. That is important because it implies policyholders do not all surrender their policies at the same time in our model. Instead, some policyholders are more likely to surrender, other policyholders are less likely to surrender, and that allows us to calibrate our model to empirical data. And that's exactly what we do. So in our model, we need to simulate the return on the policy and the yield curve, the interest rate. And we do that using a dynamic financial market model and the balance sheet of the insurer, which we both empirically calibrate to the data we have about German life insurers. And then we estimate this net cost component, which depends on 3 parameters in our model, by matching the model implied surrender rate to the BaFin data, the data I showed to you before in the empirical analysis. So having calibrated this big model, what we can do with it, we can simulate an interest rate rise. And we do that simulating an interest rate by 20 basis points per year, which is pretty modest, given the evolution of German government bond rates in the past year. So here's what happens. In the left figure, the dotted line is the interest rate. As you can see, it increases by roughly 20 basis points per year. The dashed line is the investment return of the insurer, which is endogenous. It's driven by the financial market model and the balance sheet of the insurer. And as you can see, the investment return is largely stable throughout those 10 years of a rise in the interest rate. And why is that? It's because the long-term assets insulate the investment return from the interest rate change. Now, the investment return determines how much the policyholders receive. This is the policy return, the blue line, the solid blue line on top. And as you can see, the gap between the policy return and the interest rate shrinks over time. And that is because the policy return and the investment return is insulated from the changes in the interest rate. Okay. As an implication, when you think back about the trade-off I showed you before, the benefit of staying with the insurer declines. It becomes more attractive to surrender. This is exactly what endogenously happens in our model. On the right-hand side, we see an increase in the surrender rate. And now, finally, what we are interested in is to see whether that forces the insurer to sell assets. Now we have all we need. We can calculate how much the insurer needs to sell in order to be able to pay out those surrendering policyholders. And to quantify the price impact, we scale up the insurer to the size of similar European insurance business. And we use Greenwood et al.'s the 2015 JFE papers price sensitivity measure. And then as you can see in this figure, after roughly 3 years of a rise in the interest rate, the insurer needs to sell assets in order to be able to pay out policyholders that surrender their policy. And so that increases or leads to a positive price impact, which is the dashed line over here, and that increases to almost 100 basis points. So because of increased surrender activity, there is an additional price decline of almost 1% because of insurers that have to sell their assets. And because they have to sell below fundamental prices, this is a cost for insurers, which is roughly 10 to 15 basis points of their initial equity capital. What is nice about having this model is we can run counterfactual calibrations. And we do that varying the duration of the insurer's assets, which is here on the x-axis. And what you can see very clearly is that when the asset duration increases, so the asset investments become more long-term, this leads to a larger price impact, which is on the y-axis. And why is that? It comes back to the main trade-off of this paper. It's that when insurers invest more long-term, this insulates the policy return even more from fluctuations in the interest rate. But that implies that when the interest rate increases, the benefit of staying with the insurer is lower for policyholders, so they have more incentive to surrender their policy. Insurers have to pay out more to surrendering policyholders, which forces them to sell more assets, which leads to a larger price impact. And that leads me to conclude. the main takeaway from this paper is that there are two key features that are very interesting in the policies that life insurers sell, namely that they guarantee surrender cash values that they pay out to policyholders that surrender their policy early. And at the same time, insurers invest their assets in very long-term investments. And so together, these two observations or characteristics of the life insurance business, they imply that there is more surrender activity when the interest rates increase. We provide empirical evidence for that. And what it implies in a very broad, general sense is that when we think about life insurance surrender, this is actually pretty similar to bank deposit withdrawals. And we know from a large banking literature, then this relates to financial fragility and fire sale externalities. And this is exactly what happens here in our paper. What is interesting from an insurance perspective is that the results imply or suggest that there's a trade-off between the value from asset installation, which is that insurers invest in long-term investments to insulate the policyholders from asset price fluctuations, but at the same time that increases and leads to more financial fragility because of the surrender option that is included in the life insurance policies. And this fragility, we estimate looking at fire sales and the associated price impact, which we estimate to be pretty significant under plausible assumptions, which suggests that these kind of surrender options may contribute to the systemic risk that is posed by life insurers. So that's it. Thank you very much. I very much look forward to have this discussion. Thank you.
Thank you. And so on time.
I had a timer.
Aha, well, very good for you. Our discussant for this paper is Pab Jyotikastira, and I apologize if I'm not getting that right. Welcome and thank you for taking on this discussant.
Thank you so much, Sharon, for inviting me to discuss this very interesting paper, and thanks Christian and co-authors for writing this paper and presenting it so well. So I won't have much time to discuss because it's 5 minutes. So I'm just going to give the summary of the paper. So basically the paper models and basically quantifies, which I think the most important part of the whole exercise, the effects of rising interest rates on insurance policy surrenders, which in turn change duration gaps in the assets and liabilities of the insurance companies and possibly exhaust insurers' free cash flows, and as a result induce fire sales of assets. And they quantify these effects to be like, if the interest rates were to increase by about 25 basis points per year, then the amount of surrender will increase up to about 30% of the policies in force, by year 5 or 6 or so, and that would translate into a fire sale of a significant amount that could erase up to about 0.15% of insurers' initial equity per year, and this could accumulate over several years. So my thought is that, I think this is a very policy relevant paper. It's a very ambitious paper. It's a huge model with a lot of details. So the authors detail, every single thing in the insurance balance sheets, and including the behavior of the policyholders. They do a very careful calibration to map the observable aggregates, including the surrendering behaviors, as well as durations of policy and asset portfolios. And generally, I think that the results are highly credible. Now, I actually have only one comment, but I will present in 3 parts. And if I run out of time, I'll just skip and go to the end. But the main message I want to convey is that I think, the paper may have a little bit too much stuff in some areas that are not too important, and maybe too little in other areas that are very important. I think that the paper has to focus in the right place. So I think, obviously it's a big paper with lots of details, and I find it very difficult to follow at times. It's true for my own paper as well in some sense, but I think, this is not an easy paper to read, but it is a very good and important paper. I find that, the first 20 pages in tables 2 and 3, which are about the confirmation that the surrenders increase as interest rates rise, is not really new. In fact, we have known for over 20 years that this is the case, that surrenders tend to increase when interest rates rise, right? And so I think that it is good to confirm, but maybe we can move that to the appendix to reduce the amount of, distraction that the readers would have to endure before they get to the core part of the paper. I think sections 3 and 4 are the core part of the paper and the most important. They describe, the policy returns and cash value. They describe the surrender behavior of the investors, and they describe the policy portfolio, which all of these are important, and it is very good calibration that the authors are doing. However, I am a little bit disappointed in the part of the asset portfolio where the authors basically take the actual observed asset portfolios as that portfolios that they hold constant throughout the entire simulation, which I think may kind of miss the point in the whole exercise. In addition, I feel that the calibration of the interest rate processes, the credit spread processes, the stock returns, the asset returns, and so on, I think, it shouldn't have to be done because there's so many papers that have done this kind of thing that the authors could basically take off the shelf. And they have done it in a better job in terms of, calibrating to match the actual processes of these asset prices. Just to give you an example, the authors tried to match the interest rate process, which assumed to have the mean that kind of increase as the authors tried to analyze these rising interest rates. But then, like in reality, in the past 20 years, interest rates don't rise at that rate, right? And so as a result, it forced some other parameters to be biased in order to match that sort of rising mean level of interest rates. Moreover, they tried to calibrate this to match the term structure of interest rates, which, mean that the parameters that they estimate are basically risk neutral parameters, not really the physical parameters, because it is the risk neutral parameters that basically match bond prices, and the physical parameters will match the processes of the interest rates, right? And so as a result, you can't, like, it's a huge job in even matching the interest rate process. And people like Ken Singleton write papers just to do that, right? And so they have done a better job, just take it off the shelf. But what I think the authors could do more is try to link the asset portfolio that they observe to the behavior of surrenders and the policy portfolio, right, to the liabilities, such that when you do a simulation and you change the assumption about how the interest rate would change or how the policy portfolio would change, you could allow the asset portfolio to change to match, right, that changing circumstance, right? In addition, I think there's also strategic complementarity that may have been ignored here, in the sense that the surrender rate may rise, and that force the insurers to face negative free cash flows and engage in fire sales, because fire sales suppress asset prices, and that will create a reduction in investment policy return, which in turn could generate even more surrenders, right? And so as a result, this kind of feedback loop is, and in fact, I think quite important, in a sense, could amplify, the effect that the authors estimate significantly, okay? So I would just, jump to my conclusion because I'm running out of time. And I think this is a very important paper, and I encourage everyone to read it, especially regulators and policymakers in the audience. And I suggest a couple of doable improvements. And I think the key is to focus on what is new and what is the core part that the paper brings to the table, and try to minimize the distractions in the calibrations from the other things that are not really the key idea of the paper. Thank you very much.
Great, thank you very much. Thank you to the presenters and the discussant for excellent presentations and insights here. There are a couple of questions or comments in the chat that I'm going to direct the authors to, but in the interest of time, I think we need to move on to the next paper. So I'll invite the authors to, again, interact privately with the discussant and with those who have provided comments and questions.
Thanks a lot, Pep. Just say thank you.
Our next paper will be presented by Xiaochen Qing on product innovation in the variable annuities market.
Thank you, Sharon. Can everyone see the shared slide? Great, thank you. Hello, everyone. My name is Xiao Chen, and thank you for your interest in my joint work with Dr. Daniel Bauer. The title is Accommodation or Obfuscation, Product Innovation in the Variable Annuities Market. We are interested in this topic because variable annuities have very complex design and lots of innovation as an insurance product. On one hand, they can potentially provide accommodation to risk management needs, but on the other hand, they may also be used to take advantage of, or in another word, obfuscate uninformed consumers. Is it accommodation or is it obfuscation? Without further ado, let's jump into the presentation. First, I'll talk a little bit about the background on variable annuities and innovation in the market. Variable annuities are separate account life insurance contracts linked to a list of financial instruments. They are like mutual funds, but with tax advantage, higher fees, and their payoffs are related to the owner's mortality. This is a big industry as they count for $2 trillion in the net asset in the US market alone. One thing that deviates variable annuities further from mutual funds is their optional features. The guaranteed living benefits, which are long-term or lifetime ongoing benefits as long as the policyholder is alive, and the guaranteed minimum death benefits, which trigger at policyholder's death. These optional benefits are quite popular among policyholders, as about 75% of all new variable annuities include some sort of the guaranteed minimum benefits. However, the product landscape has changed dramatically over the past 25 years, as most benefits in the early days are various forms of death benefits, while on the other hand, the guaranteed lifetime withdrawal benefits have become the most popular ones for the past decade. There are plenty of product variation in the variable annuities market. Some are radical innovations, for example, the categorical guaranteed minimum benefits, such as the GMAB accumulation benefits, GMIB income benefits, and GMWB withdrawal benefits. These innovations fundamentally change the payout function of variable annuities. Innovations in other contract features are relatively incremental. For example, there may be a clause about surrender charge or free withdrawals in the contract. These are kind of a little bit of discount or reward if certain condition is met. On the other hand, variable annuities are complex products. Their payout functions depend on multiple dimensions, such as the mortality, the performance of underlying assets, and policyholders' action throughout the entire contract period. With increasing product complexity, it becomes more and more difficult for average consumers to know which variable annuity to purchase and how to behave optimally under a contract. There's rich literature studying product innovation and their potential drivers. A classic view on this innovation is that they take the spanning role and reduce the market incompleteness by offering previously unavailable product features. Recently, another stream of the literature pointed out the potential dark side of product innovation. Gabex, Lipson, and Carlin provide models in which firms can strategically manipulate product attributes and complexity for profit maximization. In particular, firms may shroud part of the unattractive attributes or make it more difficult to understand, so consumers are less likely to choose optimally. On the empirical side, Henderson and Pearson examine a series of retail securities and find that under reasonable assumptions, these securities are significantly overpriced with no tax, liquidity, or other benefits. Celeria and Valade studied the retail structured products and showed that more complex products have the higher headline rates, which firms use for advertisements, and these products are also more risky. However, they don't have better exposed performance, yet are more profitable for the issuers. More recently, Bakata also finds these patterns in yield enhancement products, which are commonly sold to households. And in this paper, we are trying to study what drives product innovation in the variable annuities market. We provide a stylized model on product price and complexity design that combines virtuous and obfuscating product innovation, where the former expand the scope of attainable consumption path, the latter obfuscate unsophisticated consumers. Using variable annuity contract information, we find that first, product complexity is low when the whole category is introduced. And after the first introduction, product complexity increases for years and then stagnates. And finally, there's a positive association between product fee and complexity, but first innovations usually charge higher fees. This evidence supported the hypothesis that virtuous and obfuscating innovation coexist in the variable annuity market, which poses difficulty in view of consumers and policymakers. While regulators can facilitate contract standardization to make it more difficult to obfuscate, this can also stifle virtuous product innovation. Okay, next, let me introduce the data we use in this paper. All information in a variable annuity contract is available in the product prospectus, which are typically several hundred-page long with lengthy description on each feature spread all over the document. We got our data from the Morningstar Annuity Intelligence, which record numerical values for fees and textual descriptions for add-on features and conditions. This information helps us measure two key variables for our study: the contract complexity and price. We took it from Celeria and Valade's QGE paper and measured the complexity of a variable annuity contract by its description length and number of scenarios. And on the other hand, the price is measured by the total charge of the contract, which generally include the M&E fee, the benefit fee, and the investment account fee. Let's see some descriptive result of the data. So this is a graph on the active variable annuity contracts and their complexity. The bar plot represents the number of the active variable annuities, which increases sharply until around 2008, and it exhibits a significant dip around the financial crisis as many insurers might leave the market or de-risked. On the other hand, the red line represents the average character count of benefit description for those products. And we can see a roughly upward trend the whole time, suggesting product designs has become more and more complicated. And these two box plots shows the fees of variable annuity contract as a whole or the benefit part alone. In general, we can see an increasing trend in both plots, suggesting variable annuities are getting more and more expensive. This, together with the increasing complexity, is in line with the recent findings in other financial markets, that the price and level of complexity of products are positively correlated. So it seems that we can draw a similar conclusion that innovation in the variable annuity market is also driven by obfuscation and shrouding. Well, maybe not so fast. To study why firms design new variable annuities, we first need to ask the question, why do consumers purchase them? Many researchers have tried to answer this question. Tax advantage can be a big reason, but this doesn't explain why the costly guarantees are also so popular among policyholders. There's also this argument that variable annuities are sold, not bought. One consideration is that the variable annuity salesperson is usually heavily commissioned, and this creates an agency issue, incentivizes them to pressure consumers to purchase ill-fitted variable annuities. But we think what is often overlooked about variable annuity is that they are also insurance product that provides protection against the bundled risks that are difficult to obtain otherwise. For example, a GMDB combines bequest motives to an annuity product. A GMAB provides a long-term put option. A GMIB provides protection against joint movement in equity and interest rate markets. A GMWB provides a liquidity buffer, and a GLWB bundles protection against financial and longevity risk. Further our study by analyzing product trends in each major product category, as we believe that the introduction of a new benefit category presents a more radical innovation. In particular, by providing a new contingency or bundling certain risks, these new benefit categories can be beneficial to consumers by reducing market incompleteness. We use box plots to show the complexity at benefit level. From the aggregate trend at upper left corner here, we can see an increasing trend in both measures for the complexity. While looking at benefit-specific plots, the complexity seems to increase within a few years after the submarket inception and then stagnates thereafter. This is especially true for GMABs, GMIBs, and GLWBs. Since the benefit-specific increase occurs at different times, could the increase in complexity in general be an aggregation of the benefit-specific trends? Contrast Bs in aggregate and benefit type submarkets shows a similar pattern. We can see an increasing trend for prices in the aggregate market for both measures. We can also see upward trends in the submarket plots, which again raise the question on how the aggregate trend is formed. We believe that besides obfuscating innovation, virtuous one also exists in the variable annuity market. There are those early innovations that expand to new submarkets. Their signals may get buried when we only look on the aggregate level, and a benefit level analysis may help us understand a more complete picture. To allow for both virtuous and obfuscating innovation, we extend Carlin's 2009 model to study firms' behavior in product pricing and complexity design. Essentially, we allow firms to engage in both virtuous and obfuscating innovation and introduce heterogeneity in consumers' preference. We find that successful innovators, or those who successfully innovate products in new categories, choose monopolistic price, lowest complexity, and attracts sophisticated consumers in equilibrium. On the other hand, unsuccessful innovators will shift to obfuscating innovation. They face the trade-off between attracting more sophisticated consumers with low price and overcharging more from unsophisticated consumers with high price. Last but not least, higher competition will lead to a higher level of complexity, which instead of the usual zero profit equilibrium. Our model predicts that for firms succeed in early new innovation of new benefit types, they will design low complexity and charge high price for these products, which we call virtuous innovation. Other firms may follow up and try to get a share of profit in the newly formed submarket. They engage in obfuscating innovation. In this case, we should see increasing complexity level where more competitors are in the market, which will eventually stagnate. And we should also see that high complexity will associate with high price. Now let's check out the regression analysis. This is the general equation we use for the benefit level analysis. Our dependent variable is the complexity measure for contract I in the first equation, which can be the description length or number of scenarios. Or in the second equation, we use the benefit fee for our dependent variable. We regress them on company fixed effect and benefit type dummies. And our variable of interest is put in the feature set xi, which I'll introduce in the next slide. We test hypothesis 1 of low complexity by checking whether benefits that are introduced early in the product cycle exhibit low complexity. For hypothesis 2 of increasing complexity, we analyze the time trend in submarkets. And for hypothesis 3, we investigate the same variables in the fee regression. In our first model, we include a linear time trend, benefit dummies, benefit-specific time trend, and an indicator if the benefit is one of the earliest 5% products introduced in the submarket. As we can see, the coefficient for early 5% dummy is negative and significant, which suggests early innovation in submarkets are less complex. In the first column, the coefficient for year is positive and significant, suggesting that contracts in general are getting more and more complex over time. The benefit dummies, as well as the benefit-specific time trends, are mostly significant, suggesting significant difference between benefit types. And when we include benefit-specific time trend in the second column, the aggregate time trend is not significant anymore. These results fit our model's prediction. In particular, early innovation are less complex, and afterward, more firms enter the newly formed submarket and offer their innovation. With more competitors in the market, firms are incentivized to increase product complexity. To better capture the increasing then stagnating trend we observe in the descriptive results, we introduced this pair of inception-related variable T0 and Tx, which will create the increasing then stagnating trend in green if they are similar in magnitudes but opposite in signs. We put them in the regression equation and vary Tx from 4 to 5 years, and in both cases, we can see the pair of variables are indeed similar in magnitudes but opposite in size. This is also in line with our theoretical prediction. A few years after the submarket inception, competition may approach to the limit, thus the product complexity doesn't increase as much anymore. We switched the dependent variable to benefit charges and did similar analysis. In the first row, we can see that the coefficient of early inception is positive but insignificant. We think maybe 5% is too many, so we test only the first inception as an alternative, which means the product is introduced within the first year of submarket inception. And the coefficient is again both positive and relatively more significant. This supported the hypothesis that early innovation in submarkets are more expensive. The coefficient for year is also positive and significant, suggesting that contracts are getting more and more expensive over time. Same with the coefficient for complexity. In line with previous study, we also find positive association between product complexity and price. All these findings are consistent with our model. Firms with virtuous innovation charge a monopolistic price at submarket inception, and firms with obfuscating innovation charge higher price for more complex products. The Morningstar Annuity Intelligence offers an alternative definition for benefit categories, which distinguishes 12 different types of VA benefits based on key features. For example, depending on the formula to calculate terminal benefits, the major GMDB category is further divided into these 6 subtypes in MAI. We rerun our analysis by MAI's category definition, and the results are qualitatively identical to our main results. In particular, we also find early innovation are less complex and product complexity in submarket increase than stagnates. And we also find early innovations are more expensive and product price are getting higher as time passes, and that there's a positive association between product price and complexity. To conclude, in this paper, we extend Carlin's model for product complexity by allowing for virtuous and obfuscating product innovation. And in equilibrium, these 2 types of behavior coexist. We analyze contract data in the variable annuities market and find that the aggregate market trend is potentially composed of temporary benefit-specific trends, with virtuous innovation in the beginning and obfuscating innovation following up. Our findings can have different implications on consumers, firms, and policymakers. For consumers, if both virtuous and obfuscating innovation coexist in the market, price should not be the only factor to consider, and it's important to understand one's own need for risk protection. For insurers, it would be beneficial to assess risks that are not covered within the existing market. And for policymakers, it's worth noting that although they can facilitate contract standardization to make it more difficult for obfuscation, this may also increase the cost for virtuous innovation and ultimately hurt welfare instead. An interesting question we have at the moment is, what companies are more likely to engage in virtuous innovation? Would it be bigger firms or those with better reputation? Also, how will a firm's financial position affect that decision in innovation? Thank you.
Thank you. Interesting. And thank you for being on time. Our discussant for this paper is Amanda Stark.
All right, can you see my slides?
Yes.
All good.
All right. So thank you for inviting me to discuss this very nice paper. I just finished teaching. And so because I just finished teaching, I'm going to start with the slide that's going to look really out of place, but is directly from a slide that I use in the core strategy class. And that's about spaghetti sauce. And so I use this as an example of horizontal differentiation. And the basic story here is that in the 1990s, Prego is struggling to catch up to Ragu despite having arguably better spaghetti sauce. So they do a little research and they discover that it turns out people have heterogeneous taste for spaghetti sauce. A third want plain, a third want spicy, and a third want extra chunky. Okay? And so rather than offering a single product, they can introduce product variety to the spaghetti sauce aisle. And if any of us had actually been to a grocery store in the past year or so, we would have realized that there are now like literally infinite varieties of spaghetti sauce on the market. This is actually a very profitable decision for Prego. And then, we talk a little bit about entry within these smaller niche product segments. So why did I think of spaghetti sauce rather than variable annuities? Or put differently, how are variable annuities like spaghetti sauce? And so obviously there are big major differences here, but on some level, the core question is the same. We would argue that all of this product variety in spaghetti sauce is at least weakly good for consumers, because it turns out some of you do want plain spaghetti sauce while others want extra chunky. And so the question is, why is it the case that that may not be true for complex financial products? I think there's two big issues to talk about here. One is sort of the core idea of the paper, and one that I want to come back to later in my comments. So the main point is that variable annuities are not like spaghetti sauce, because it's really hard to understand variable annuities, and you can't take it home for $3.99, try it out, and decide you want a different flavor next week. Right? So given that, we have to think a little bit harder about what the role this complexity plays in the market. And then the point that I'll come back to is thinking a little bit more about selection, which is less what this paper is about, but I think an interesting direction for future work. All right, so we have to think about complexity. The traditional sort of spaghetti sauce view is that product variety is good. Consumers have full information, or it's relatively cheap for them to acquire that information, and they can sort into the kind of spaghetti sauce they like. The sort of more behavioral view, or the sort of personal finance expert view, is that these things exist, these complex products in this market exist to make the advisor money, right? So we want to compare and contrast these two views, and this paper actually charts a sort of middle ground and argues that there's some virtuous product innovation that is going to cater to a subgroup of customers that have different preferences, right? These are our extra chunky spaghetti sauce consumers. At the same time, we have this obfuscation going on, where this obfuscating innovation increases the complexity, and that's really about targeting unsophisticated consumers. Okay? So I think this is almost certainly true, right? Like I on a very basic level totally buy this argument, and this seems completely sensible to me. As a quick aside, this is a really hard problem, and they're doing a great job with the data, which wasn't, they didn't spend a ton of time on it here, but it's a hard problem. They're using some natural language processing to classify the products. I quite like this approach. I think this could be useful for other researchers, and only because I think it could be very useful for other researchers, I'd encourage them to think a little bit more about validation and ways to test robustness. If for no other reason, then I want to go back, look at their paper, figure out what they did, and do the same thing. Okay. I think that could be useful in other settings as well. Okay. All right. So we've got to figure out if this complexity is good or bad. And I'm going to reframe the question a little bit differently. And the basic question that we have is, this is going to be a welfare enhancing innovation if at the end of the day we've increased willingness to pay relative to marginal cost. But of course we've got a problem here, because the first thing we have to answer is, what the heck is willingness to pay here? Because we're not going to be super confident with sort of a revealed preference benchmark. Why are we not going to be super confident with a revealed preference benchmark? Well, because if we're worried about obfuscation, we're worried that consumers aren't fully informed, so using their choices to back out willingness to pay is not going to be informative. And they sort of have this very sort of clever way or sly way of hammering this point home. So in pages 5 through 7 of the paper, they describe a bunch of different contracts. I spent a lot of time thinking about health insurance contracts. I don't know variable annuities as well. And as I was sitting there, I was like, okay, I get it, right? Like it's a lot. And so as I was like tearing my hair out, trying to figure out, how you would even begin to evaluate these things, you get the point, right? And so we have to think about measuring willingness to pay here, and that's going to be challenging. I think there's other ways we could try to chip away at this problem. Is there any way that we can think about estimating the proportion of sophisticated consumers? Sort of thinking about consumers who aren't, say, making expressly dominated choices or something like that. Are there any consumers that we believe are better informed ex ante? Do we believe that advisors are actually playing a useful role? So buying through a broker tends to lead to better choices or not? I think that would be informative. Something I wrote in the margin as I was reading the paper, like, why isn't there demand for simplicity here? In the sense of, if I, a smart person who thinks about insurance markets but doesn't think about this particular market, and tearing my hair out reading pages 5 through 7, I'm probably willing to pay a premium to have the thing that is like simple and easy to understand. And also sort of buried in footnote 4 is the fact that there are some market shares that you could get here. So I think it would be interesting to think a little bit about what the market shares themselves would tell. So just some ideas for thinking about other ways to sort of triangulate and think a little bit more about willingness to pay. All right, so the next question is willingness to pay higher than marginal cost? And here's where I think this, again, future research, but something to think about is the degree to which there could be selection in this market. And so I took a figure from a student of mine's paper, just sort of thinking about ways to measure willingness to pay relative to marginal cost and the social surplus that's going to generate, because that's going to affect what kind of product variety we want in equilibrium. And so this is a harder problem than her problem, because she assumed away that willingness to pay problem that I was just talking about. But I think, again, there are other ways we can think about sort of triangulating and getting at this a little bit more. You know, it would be interesting to know if sophistication is correlated with the cost to serve, right? There is an insurance component here, and thinking about thinking about this from the firm's perspective, if I'm attracting a bunch of sophisticated consumers, do I want those guys or not? I think would be interesting. And also whether or not there's a cost to firms of additional product assortment. So I think these are other interesting questions. Again, I think it's for future work, but interesting things to think about and could be productive. All right, a few nitpicky points, all free disposal. And if I'm running out of time, you can stop me. I might change the language a little bit. In the paper, the word virtuous has like a very normative connotation, which I think you sort of go back and forth on whether you want that normative connotation. And so I might just pick a less loaded word. A bit more institutional detail for the general reader might be helpful. I worked through it eventually, but it took me a minute. I think thinking a little bit about some robustness checks in terms of how you define the early 5%, whether or not there are dynamics that are interesting. For what it's worth, I love the figures, and I might emphasize the figures a bit more because I find those very helpful relative to the tables. And I might move section 4.2 to the appendix, but like these are all very free disposal and nitpicky. So really enjoyed reading the paper. I think we can learn something about spaghetti sauce from variable annuities and vice versa. And it's a really nice paper. So thanks so much for asking me to discuss.
Great, thank you for those comments, and thank you to the presenters for your presentation as well. There is a question that's been posed in the Q&A, and I'm going to refer the authors to that question to respond privately in the interest of time. And again, I'll refer you to respond to Amanda regarding her comments as well. So we have one more paper. This will be presented by Joyce Lin. It's on race discrimination in the adjudication of claims. Joyce, do you want to share your screen?
Yes.
Oh, you're working on it, sorry.
Yeah, sorry. I just unmuted myself first. Should be ready to go. I will make it full screen. Yeah.
Great.
All right. Hi, everyone. Yeah, can you see my screen? All right. Just let me know if you can see or you cannot hear me that well.
Yes, everything is great.
Okay, thanks. And thanks everyone for being here. My name is Xiao Ling, or you can call me Joyce. I'm assistant professor at St. John's University. And today I'm going to present the paper titled Race Discrimination in the Adjudication of Claims, Evidence from Earthquake Insurance. This is a joint work with two of my colleagues here at St. John's, Mark Brown and Annette Hoffman. So the topic of race discrimination has attracted the interests of a lot of people, including economists, not just the recent events, but because of both social justice implications and market implications. Starting from previous literature, the economics of discrimination started from the seminal work by Gary Becker, who published this work in 1957 and who later won a Nobel Prize in the early 90s. He formalized the phrase taste-based discrimination, that is an animus towards a racial group. But this type of discrimination should be driven out of competitions, should be driven out of markets by competitions. And then another form of discrimination, statistical discrimination, is formalized by economists, including Phelps and Arrow. Statistical discrimination describes decision makers using observable characteristics such as race and gender to proxy for economically relevant but unobservable information. So statistical discrimination is quote unquote fair at the margin and cannot be driven out by competition, but it is not harmless. It does result in inequality on average, and it poses an equity efficiency trade-off. And thirdly, discrimination can be self-fulfilling sometimes. So basically the party being discriminated against sometimes simply do not try that hard anymore in anticipation of either taste-based or statistical discrimination. So there are quite a lot of studies on the empirical evidence of discrimination, either race or gender discrimination in a variety of markets, including labor markets, various credit markets, mortgage lending markets, peer-to-peer lending markets, and so on. So in summary, there has been mixed evidence on whether racial discrimination exists, and if it does, in what form. Basically, whether this is taste-based or statistical-based discrimination, and whether discrimination has been self-fulfilling. So research on discrimination in insurance markets has been relatively sparse, and we guess partly because risk underwriting is based on or is built on statistical discrimination. Prior literature tests for discrimination tend not lead to findings of discrimination because most of them test for racial discrimination in insurance pricing, such as these couple of papers here. Which is consistent with the notion that taste-based discrimination should be driven out of competitive personal line insurance markets. And the two papers that are closest to our research are probably these two by Derpinghaus et al., who investigate gender as well as age discrimination in auto insurance claims adjudication. In particular, the assignment of faults by claims adjusters, controlling for the degree of actual fault. And they do find evidence of differential treatments of assignment of claims by gender and by different age groups. And they contribute their findings to claims adjusters' perceptions of policyholders' different negotiation skills and risk aversions. So our research focuses on earthquake insurance claims from Oklahoma. So these are basically a set of events, each affecting a relatively large group of people. So hopefully we do not need to worry too much about individual differences for each of these events. And we combine policy level claim data with zip code level demographic data and to investigate two claim level outcomes. First, the likelihood of a claim being paid, and second, the amount of settlement given that a claim was paid. So basically whether these two outcomes are different between zip code areas with larger minority population versus zip code areas with larger white populations. All right, so I will just go right into the background section of our empirical analysis. So the background here again is in Oklahoma. You may or may not have heard of this, but there has been quite a lot of earthquakes in Oklahoma since 2010 because of the oil and gas drilling activity known as hydraulic fracturing or fracking. There has literally been thousands of smaller magnitude earthquakes, but including a number of noticeable earthquakes in the range of magnitude 5 to 6. There has been a few news reports, including a New York Times article interviewing homeowners who suffer significant damages from these earthquakes and who generally have not been successful in claiming any compensation from their insurers. Well, earthquake insurance is separate from homeowners insurance. So unfortunately, not a lot of homeowners have earthquake insurance to begin with. But even if we just focus on those earthquake insurance and those earthquake claims, according to the Oklahoma Department of Insurance, it reports an, quote, extraordinary denial rate, and only 8 out of 100 claims were paid in 2014, unquote. So this has been a pretty contentious issue, why so many claims, so many earthquake insurance claims were not paid. So the Department of Insurance issued data calls, rolling data calls every year to all the insurers in Oklahoma to submit all of the earthquake claims filed by their policyholders. And we obtained this data set from the department, and the data set covers a time period of roughly 7 years from 2010 to 2016. And we claimed it and we matched all these individual policies or individual claims filed with to 8 earthquakes within this time period. So these are 8 most noticeable earthquakes in Oklahoma within the 7 years. A couple of these earthquakes resulted in a couple hundred claims filed each, and then some of these earthquakes resulted in dozens of claims. So in total, we have 846 claims filed. And out of these more than 800 claims, approximately 30% or 253 claims were paid, resulting in an average claim payment of a little more than $13,000. And the largest single claim paid is a little more than $200,000. And we also have other policy level characteristics regarding policy limit, deductibles, and so on. So for each of those 846 claims, we see the policy limit, which is basically the value of the structure of the house, and also the deductible. Earthquake insurance has a percentage deductible, so a deductible that is a percentage of the policy limit. The percent ranges from 2% to 25%. It's a little difficult to imagine a deductible as high as a quarter of your policy limit, but we do see those in our data set. But the majority, or more than 50% of these policies, these claims filed, carry the minimum possible deductible at 2% of the policy limit, translating into dollar terms, that's a median deductible of $3,760, and the average deductible is a little bit higher. For each claim filed, we also observe the delay, the policyholder's delay in notice of claim, measured in number of days. And we also observe whether or not each claim has an engineer report on file. A majority of them do, and whether or not the claim has public adjuster involved. So this is different from insurance adjuster. Public adjuster is hired by the policyholder, not the insurer. So in fact, relatively few, only a little more than 1% of our claims involve public adjusters. And even fewer, 0.59% of these claims involve legal counsel. All right, and next we link our claims to US Census data based on the location information of these claims. The location information is simply the zip code. So we only know the zip code when it comes to the locations. And we match these two data sets, the claim data set and the census data set by zip code. And we found that those 846 claims come from 182 different zip code areas in the state of Oklahoma. There are more than 600 zip code areas in Oklahoma. So this represents slightly less than 1/3 of the state zip code areas, but it still is quite impressive. And we think that it represents a good level of variability when it comes to zip code areas. So we take down information on zip code level population, population density, median income, median home value, education, and most importantly, a set of race composition variables. So basically within each zip code, what percentage of population are Black and the percentage of population that are Native, Asian, and Hispanic. And by the way, we take our census data from the American Community Survey, or the 5-year American Community Survey, which is a 5-year rolling average. So our study period is 7 years. So we treat the census data as fixed rather than time varying. These are just a couple of maps visualizing some of the bigger earthquakes over the 7-year period. This is the 2011 Prague earthquakes. Both the left-hand side and the right-hand side are the same earthquake. But on the left-hand side, the color-coded zip code areas indicate places where claims were filed. And on the right-hand side, the color-coded zip code areas indicate places where claims were paid. So the little red pentagon shape in the middle, this represents earthquake epicenter. It's the same for both of these maps here. And lastly, the crossed areas, which on the map we indicate shaking area, and in the text, in the paper, we refer to this as possible damage zone. We did not define this. This is based on definition by the US Geological Survey. So basically, the USGS, after each earthquake, it defines a zone or a boundary, which is approximately a circle around the epicenter, but not exactly, sometimes with some irregular shape. But the USGS draws the boundary and says that based on the shaking intensity, and says that any places outside of the boundary, there should not be any physical damages. So we define this as possible damage zones for each, there's one zone for each earthquake. You may wonder how or why there are claims filed from places outside of these possible damage zones, and even some of those claims were paid. And we were wondering about the same thing as well. So in the empirical analysis later on, we always sort of run two regressions at the same time, one with the full sample size and the other one with a subsample that focuses only on claims filed from within the possible damage areas, so as to minimize the concerns of fraudulent claims. All right, this is simply the largest earthquakes, I think, 2016 Porny earthquake. So empirical approach, the very first equation here, this is our baseline model. Our outcome variable is at the claim level or the policy level. So we treat each policy, we look at each policy, what is the outcome of that policy, whether or not that policy is paid. Each policy is filed from a zip code affected by a particular earthquake event. And on the right-hand side, the main variable of interest is a set of zip code level race variables, or R sub J. These are, for example, percentage Black, percentage Native, etc. And we control, in our baseline equation, we control for distance to earthquake epicenter variables. So this is distance between zip code centroid to an earthquake's epicenter by each earthquake. And we have earthquake event fixed effects, standard error clustered at the earthquake event level. So the baseline assumption here are that given an earthquake event and controlling for the distance from zip code centroid to earthquake epicenter, the outcome of a claim is independent from a zip code's racial composition if there were no racial discrimination. Very importantly, we do not need to assume that each earthquake affects a random selection of zip codes, nor do we need to assume that the decision of where to live is random by race, which is probably not. But we only need to assume the random assignment of race conditional on having the same loss exposure to a particular earthquake. Well, so next we do need to address some possibilities of omitted variables concerns, namely, after conditional on having the same loss exposure, the outcome of a specific claim may still be determined by policy-specific or insurer-specific characteristics, which may be correlated with race. Fortunately, we do have data on some policy level characteristics, as I mentioned before in summary statistics. So we are able to include those insurance policy level characteristics such as deductibles, limits, etc. But unfortunately, we do not have information on insurer specific characteristics. So we can only assume that the distribution of insurance across different zip codes is independent of race because of competitions. And the second set of additional control variables, or W sub J here, these is a set of zip code level characteristics. For example, perhaps higher denial rates in a specific zip code area is due to lower educational level or lower home ownership percentage, different building types, etc. And then all of those things may correlate with race. So in our alternative model specifications, we add these additional controls, sometimes one at a time, sometimes all together. All right. And before going to regression results, some very raw descriptive evidence on the left-hand side here. This column indicates the percentage of claims being paid or approved in 10 zip code areas with the highest Black population percentage. And then on the right-hand side, this column indicates the percentage of claims approved in the zip codes with the lowest Black population percentage. And overall, you can see that the approval rate 15% on the left and then more than 50% on the right. But this is very naive comparison. So here is the regression results. This is the first results on the probability of a claim being paid. The dependent variable is whether or not a claim is paid. So we run a bunch of logistic regressions using our full sample size of 846 claims filed from 192 different zip codes. And we run a bunch of different model specifications from the baseline to adding to various types of controls.
So, excuse me, Joyce, your time is up, but so do you want to spend just a little bit of time wrapping up?
Results. Sorry about that. This is the main results. These two tables are basically identical. The main conclusion is that controlling everything else, the probability of a claim being paid is lower if that claim is filed from a zip code area with higher Black percentage. And then second sets of results, sorry, running out of time. The main conclusions here, the most robust results are the first two bullet points. All else equal, claims filed from zip codes with higher Black percentage are less likely to be paid. And then conditional on a claim being paid, claim payment amount is lower for those filed from higher Black percentage zip code areas. All right, thank you.
Great, thank you. Thank you very much. Our discussant is Nicholas Seabart.
Hello, can you hear me and see me?
Yes, everything is great.
So. I try to be quick. Thanks so much for organizing the session and to all presenters and for those of you who are attending. I'm Nicholas. I will try to summarize this paper briefly. So the principal idea is quite nice, actually. And the idea is to use the randomness of an earthquake shock that affects multiple people of different racial compositions to test for racial discrimination. So that's a great idea if you think about it. And the contribution is that a lot of the literature has used settlement of claims and that use pricing and selling and not settlement of claims in testing for racial discrimination. And we have this novel identification strategy. Basically, the results that you have seen just now tells you that we find that claims from zip codes with higher shares of Black people are less likely to get paid, and if they get paid less. And then the other part that that wasn't presented is actually also a nice element and finding that leads to a less sharp conclusion, namely that the likelihood to file questionable claims is also higher in zip codes where we have higher shares of Black populations. So the database, another nice element of this paper is threefold. We have insurance claims from the Oklahoma Insurance Department over 7 years. We have really nice earthquake location and intensity data from the US Geological Survey. And we have from the American Community Survey merged and zip code level demographics because we don't have racial and socio-demographics at the individual claim level. Another point that I would like to mention, I think that should be stressed more in the paper and maybe in the presentation, is there's been some increase in earthquake coverage take up from 2% in 2011 to 15% in 2015. And there's been these man-made earthquake exclusion clauses. So 92% of claims were denied in 2014. And then there has been clear evidence that the Oklahoma earthquakes, at least, are caused by fracking. And so the Oklahoma Insurance Commissioner asked insurers to clarify this in October 2015, which is a nice event that I come back later to. And the authors write that the majority of insurers clarified that they do cover those events, which is kind of an exogenous shock, not a shock if you think about it. Here's one main outcome table. So the dependent variable is the claim paid or not? And then you have a bunch of controls and a bunch of assumptions. And we find that in zip codes where we have a higher share of Black populations, it's less likely that the claim is paid. You saw this graph, which I really liked, and it shows you some of the strength of the data where you have colored zip codes from where claims were filed, and then you have the epicenter and the geological area where there could be property damage, and outside the area it's not possible. That's the scientific evidence. So overall, it's a fun paper to read. It's an intriguing basic idea and very neat. I like the motivation, the literature review, and it's obviously really policy relevant or sensitive, and it's an important topic. And so I think that it has great potential. I think you can emphasize the strength of the approach more, like what I just mentioned, the exogenousness of the earthquakes and how difficult the topic is to study because we don't have racial information on individual claims data. Also, quality and compilation of your data is actually quite strong and amazing. I would prefer more institutional details. I would also prefer more details on the data, like in how far is the ASSA, American Community Survey representative, how many observations do we have per zip code included, how are the claims data sampled, and how far are they representative? I couldn't find much on that level. I really love the figures, like the ones I just showed, and I think you should try to include more on this. Try to show the findings graphically somehow. You have a limited number of claims, unfortunately, and only 253 have been approved. So I was asking myself, why can't you add more states? I mean, it seems to me possible to add more states and increase the power and use more variation from other states. And then my only other big comment, and then I leave it to maybe one more question from the audience. By design, that's not your fault. There are several stages of time varying selection possibly, right? So the selection into the take up, to purchase the policy, to the generosity of the policy, and you have some policy variables, which is nice, into filing and into legal counseling. I think you can just present it in a transparent and more systematic way, and then say what you can and what you cannot address, given the importance of the question and the difficulty of the the identification. And you can exclude some stuff, like you could take care of D by omitting those that you can identify with legal counsel. You could try, I don't know if that exists, to find survey data to analyze take up or model trends maybe in take up. You could also, I think, maybe use this exogenous shock by the insurance commissioner that needs to be clarified if claims are covered or not, and then possibly use correction methods that we know in the literature, like Emily also has a nice paper. And then I was wondering, if you could maybe show us more about balancedness, because you may be concerned about unobservables, of a lot of the nice policy variables and the sociodemographics that you have by zip code. So in what people want to see, I guess, is that you have identical claims and only people are from different shares of neighborhoods, and then there's discrimination by neighborhoods with shares of higher populations of Black people. And maybe you could use matching even one-on-one using the claims data and really making sure by design that you have balancedness. I skipped that. The other part we can clarify and stop here to be on time.
Wonderful, thank you. Thank you to both the presenter and to Nicholas for those comments. And again, I will refer you to each other to follow up with questions and comments. We have been warned by ASSA that the session will be cut off immediately at the allotted time, which is about maybe 30 seconds from now, if we're lucky. So I'll just make a quick thank you to everybody, presenters, discussants, participants. I think this has been a wonderful session, and I learned a lot. I'm really grateful for your participation.
Thank you so much, Sharon.
Thanks for moderating.
Thanks for organizing.
Thank you, Sharon.
Thanks a lot.
Thank you,
Bye,
Sharon.
everybody.
See everybody.
Bye.
Thanks, everyone.